Yeah, so welcome to NewDeal Invest webinar update here on the 26th of March, actually. Um, as you can hear, my voice is a little bit damaged. But yeah, it's the best it's been in a week, so I hope I'm getting through here. I'll stay close to the mic. If you have questions, please write them in the comments, and we'll answer some of them on the way, and some of them we'll take verbally. Yeah. So let's get into it. Today's agenda is, first of all, today is the first update we do in English, and that's because we already have quite a large investor base in non-Danish speaking countries, because we've started on eToro platform, the big retail investment platform, international, um, which is a really modern platform. You get commission free. You can invest in our portfolio without management fee, without transaction fees when we rebalance the portfolio. So it's a great value proposition. They have a great selection of investment products, both individual products and smart portfolios like ours, where you can follow a management firm like ours. Our portfolio in there is NDI Future Tech. So from now on, the general updates, the quarterly updates, will be in English. Today's agenda will be a company overview. We'll look at the portfolio performances, and we'll look at what happened in Q1 and look towards Q2. And then I'll talk a little bit about our model for AI investment and our strategy for AI investment, how we address it, because everybody knows it's the most important investment subject right now, especially if you're a tech investment fund, but really just if you're any type of investor, you need to understand what this next era of tech evolution will do to the business model of the businesses you're invested in. So let me start out with a question here. Do you know any other funds that compare themselves to NASDAQ? And I won't say I don't, but I find it hard to recall any. Most funds would prefer to compare themselves to MSCI World, and that's around 7% yearly. S&P is really techy and growthy, and that's why it's outperforming MSCI World. And Nasdaq is just extremely techy and extremely growthy, and that's why it outperforms. So the answer is no, because it's hard to beat Nasdaq, and the only option until now has been to just buy Nasdaq, and that's not nice when you're a fund. So a couple of weeks ago, we were having the partnership launch with eToro in the old stock exchange in Denmark, and I was giving this our piece of the introduction, and you can see the slide here where I say tech stocks are undervalued because of variance that creates a problem for investors, and la 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 la. And I thought it was really, really interesting. I really think it's so interesting and so eye-opening. And afterwards, my partner, he said to me, you know, Mads, every time you tell about NewDeal Invest, it's like going to a math lecture. And I kind of had to relate to that. And so I made this farewell slide to all of the funny, nerdy, interesting things that has inspired our journey to becoming the solution for tech investment that we are today. And they're really heroes, and there are a lot of exciting stories. Stories about technology in the markets, mathematical really interesting stuff here, a different view on mathematics and time. And yeah, just a lot of my heroes. And all these stories, they are on our YouTube channel. So you can go find them there and listen to them. I think it's the most interesting and fantastic stuff you could occupy your mind with. But I'll be like Shrek when he leaves the swamp and says goodbye to all his little weird creatures in the swamp and goes to the kingdom far, far away, because it'll be see you later. So for now, if you want to hear about the funny, nerdy stuff, then go to our YouTube channel. Yeah. So just a brief company overview. We are a portfolio managing company that has a process that is designed for investing in technology and growth companies. And we use all the stuff on the other slide to create a really, really good process of this, a way to address the mathematical issues correctly. And we have a team that are extremely knowledgeable about tech, the tech sector in general. We also have a CFA, so we do all the stuff that people normally do with DCF analysis and stuff to see what's priced in by the market. So never mind which distribution channel you use, then the process and the thesis and the thinking is the same. And then we have 3 different distribution channels. And the newest one I talked about, that was eToro with the NDI Future Tech distribution channel, modern platform, big selection, smashing down coordination and transaction costs. So it's a really modern and good experience for users. And our portfolio there is NDI Future Tech. Then we have the public listed fund, which has a ticker PMI NDI. The ISIN code is there, and it's listed in Nasdaq Copenhagen, but it can be bought many places. Just ask your bank. We've been bought in a few places in Europe and also in Asia, so it's possible. And in Denmark, we are in every bank, every web bank. We are at Saxo platform, and we're not at Nordnet platform. So if you want a good platform, go for eToro or Saxo. Then we have the unlisted main fund, which requires a minimum investment of 100,000 euro. That's a part of EU regulation. There are no specific geographies that it requires. We don't take American investors due to regulatory stuff. And when you look at the different portfolios here, then you have the PMI NDI, which is the public listed fund. It's a very broad fund, one-stop solution for all tech investments. We have big tech and crypto in that. Then we have the eToro, which is also a very diversified portfolio, a one-stop solution. We have no crypto exposure on that. The crypto exposure in our portfolios will all be public listed stocks, so there are no problems with regulatory or tax issues or anything like that. Then we have the 4 portfolios in the main fund that gives you a bit more flexibility to design what you really want us to do for you as an investor. We have a very diversified portfolio without very much big tech, no crypto in it. Then we have a mature tech portfolio, which has a lot of big tech and no crypto, a lot of big tech, and then a lot of semiconductors as well, because they tend to be more mature in their financial profiles than many of the younger upcoming stocks, still large tech stocks that we have in Gorilla. Then we have the crypto portfolio, which is half just pure crypto companies, Bitcoin miners, Coinbase, MicroStrategy, Galaxy Digital, and then the other half is companies, tech companies that are really enablers of the crypto space, working actively with crypto as a part of their strategy. So yeah, it's done quite well the last year, to say the least. And then we have a concentrated strategy here, which is the best ideas, the ideas we believe the most in. And and if you go back to the nerdy stuff, you'll hear that concentrated strategy within tech is really difficult, and we manage it by being a lot diversified, but we also focus on the stocks that we really think are high risk reward value, and then we really address the value the variance a lot as well. So let's look at the performance of the portfolios. We have the unlisted main fund here, and this is year to date. So you can see we have Nasdaq here, which is the purple line, and then we have we have one fund just smashing it like it's done for the last year, and that's crypto, up 40 something percent this quarter alone, coming off a high back in early December or something like that, as well as I recall. And it topped out in the beginning of the year, so we see it falling quite somewhat, and then just ramping up again. And we've seen Coinbase, Galaxy Digital, and MicroStrategy really having a ramp, and the miners are lagging somewhat behind due to some stuff in the blockchain system. But still great potential in my opinion here. There's still some way to the halving, and so it's coming. And then we have the other portfolios, which are centering on Nasdaq and performing something like 10% or something this quarter here so far. And as you see, the initial phase here, January, was very weak for our stocks, while Nasdaq has been just ramping on the AI and elite tech stock ramp. I'll get some more back to that. Then we have the original alpha portfolio, the first portfolio that we have had. And it's really the strategy and the thinking is the same as this alpha portfolio, which is open now. When we started the other portfolios, we used the same structure for the new alpha as we did for the others. It was a clear improvement both for us and investors. So it's not a problem when you're invested, but it's better in and out. So the original alpha and the new alpha has not been performing the same in the autumn, and I've learned a lot from that, because it's something about money coming in versus money not coming into a portfolio. And that made us reflect a lot on what it meant to constantly have money to buy the dips and money to pursue the opportunities. And we've become a lot better in the original alpha, where we don't have money coming in all the time, to keep selling, taking profits, and thus always having firepower, the ability to be opportunistic. Yesterday, Catalytics was up 30%, and we were prudent to sell along the way. And today just plummeted 30% again. So it was an easy win to just buy back what we sold, and that's really become a very, very important part of our strategy. So over to the public listed fund that you can buy in your web bank. PMI NDI is the ticker. As Matthias, my podcast host, who's who's connected with India. He's a national coach for the Indy double players. He called it Bimindi because that's the way an Indian would pronounce it. The ISIN code is here if your bank doesn't recognize Bimindi. It's up 11.4% yesterday, and Nasdaq is up 8.3%. So it's fine. We're being our benchmark in this quarter, and hope to be that in a really thorough manner for the long term because of our two-layer strategy. So we are comparing with Nasdaq here. If we go back to the beginning of Pimindi, the 9th of October, we're up something like 32% now versus Nasdaq. It is way lower than that. So a really good start for Pimindi, but not raising any flags yet. The NDI Future Tech portfolio on eToro has had a great start and is up around 20% now since the inception, the 1st of December. This is a quarter to date or first quarter, and we're up 11% versus the Nasdaq 8.33%. So it's really good. So if we look at the Q1 tech flavors, what's been good, what's been so, and try to use that to bring the thinking further on to next quarter. Then it's clear to everyone that everything that people has thought of as AI is just been immense ramp. So AI semi has been on fire, and you see it here in the quarter. The orange line here is the SOX. It's an index of semiconductor stocks, and it's up 18% in a quarter. That's amazing. But you need to understand that in this index, there are analog chip producers that are just being killed right now because industrial and auto chips is just in a cyclical downturn, or has been killed in Q1. They seem, we're looking for a bottom in the next 6 to 9 months in that segment. So we're curious about these analog chip producers, especially some of the better ones. But Intel has had a weak Q1 as well, and it's one of the big ones in this index. Intel is coming up with some new system chips. First a revamp and then a new one. So they've got an interesting product line, and they've got their Intel as a foundry coming up, and they actually seem to be pulling up to get up to speed with TSMC. So it's a very interesting company that we like and that we're looking for. So, but 18% and some of the stocks in this index has been killed. So the rest of the index has been on fire, and that's everything with AI. And I'll get back to those stocks. The bar line here is Nasdaq, and then we have the two other segments here. The yellow one is the SaaS companies, and you can see the SaaS was actually doing quite well until mid-February, and then it's beginning to turn down. And there was some earnings that where guidance was disappointing in investors, or they were just priced to perfection. They've been chased a long way up during the bull market that we've seen since mid-autumn, and we've been very cautious about them because of because of their valuations that just started to seem really, really stretched. And some of them are rolling over, and we're picking up a little bit of shares in them now. It's GitLab, it's Snowflake, Sentinel-1, Palo Alto Networks. So some of them coming back to more reasonable prices, and that's good. We're long-term investors, so we don't need to chase. We can wait, and there are still a lot of names that we're waiting for to come down. And then we have the iBuy here, the an ETF of e-commerce companies that started out fairly weakly. And e-commerce is kind of where we come from as an investment fund. That was our beginning, our core competency. And we've brought on some analysts that know a lot about SaaS and semi. So we've strengthened our view and are learning that space from them, and feel we have a really good approach with our two-layer process where we know quite a lot about semi and SaaS, and we apply our mathematical models and approach to it. So yeah, I think we have the best tech investment fund there is out there at the moment, doing it the right way. But yeah, I'll let others decide that. So e-commerce came back in the quarter, and that was clearly the earnings that were beating expectations. E-commerce stocks has been so unpopular. Many of them are low margin, either because they do the logistics themselves or because they're 1P businesses, or a combination. So, and markets has not been liking low margins for a very long time. I'll get back to that. Here. So this is where we come from, the historical context. So we take the same ETFs back before COVID, and no, actually, this is just after COVID. So we have the uptick here in 2020. So let's look at the semiconductor here. So semiconductors topped here in late 22, and then they just plummeted. And standing down here late 2023, looking back, investors could have thought that there was a bubble here. Because demand was just falling off a cliff, PCs, and everybody bought what they needed of electronics during COVID. So demand was falling off a cliff, and everything seemed expensive now. And I think many were assured that that was a bubble. But what these guys here might have priced in, or somebody knew, was that the AI was coming. And now we've got a surge in semi-demand due to AI. And this was not a bubble. This was a stupidity. It was just too cheap. People selling, and right before a huge upturn. So, and what I want to highlight here is that what was a bubble and what was not a bubble, that's for history to decide. And if you go back on our YouTube channel, or if you watch the replay of the big event in person, which is in English, I tell a story about Nifty 50, which were the expensive high flyers in 1972. And they fell off a cliff. They traded at a P of 42, and they just fell off a cliff. And people were like, that was the most stupid bubble. But when you go to 1999 and you calculate what was the right price back in 1972, it was exactly 42 PE that the market priced them in at. So there was no bubble, but the market lost faith in them. And looking back, that was what happened in the semi industry here. There was no bubble, but the market lost faith. So what we remain to determine is when we go to the e-commerce here, was there a bubble here, or has the market just been irrationally losing faith here? And that's what history will tell us. Looking at many of the companies that we invest in here, I would say that there is at least a big component of market being irrationally low on faith of many of these companies, which are actually going to be building the next generation of companies leveraging AI a really, really lot. And I'll get back to that. The SOX here is the easy AI play, but down here in the SaaS and in the e-commerce companies, there are some companies that will really kick ass because of what AI enables in the future. So I could easily see them at least picking up to the Nasdaq, but also taking over the Nasdaq. So reversal to the mean will be our friend here. Yeah. Here, the purple is the Nasdaq, and this is the e-commerce index. And reversal to the mean would mean that we come up to the Nasdaq. And I would think that would be the most plausible, since the e-commerce ETF is the more techy and more growthy, so it should outperform long term. So coming back to SaaS and the weakness that we saw in SaaS in Q1, we see it here in this chart here. This is the highest growth segment of SaaS companies. The red is the middle growth median, and the orange is the low growth median. The high growth one is just like 10 stocks or something like that, of what people really perceive as elite stocks. And we see the optimism about them being great going into the quarter. And then we see people losing faith due to what I talked about the earnings coming down. And now it seems more reasonable. What might not seem reasonable is that they're trading at the same multiple as the median growth segment. So maybe the median growth segment is next for a correction. At least we are very, very, very cautious and picking our bets really, really cautious here because when we look at long-term price here, the high growth segment is priced higher than what they've been historically, depending on where you draw the line, and the median growth segment as well is kind of somewhere at the height of what it's been. But it could be reasonable as well, because these are the companies that will really benefit from AI. They are digitized in a way that they can just plug in whatever AI capabilities that are being built. So this could be reasonable, and that's really the thing about tech, that it's so hard to predict what is going to be the business models of the future, how the value chains are going to change. And that's why you need to use the more broad mathematical approach, building on top of a really good technological understanding of what is going on, what is happening. So over to semi, just to dissect the semi industry a little bit more, to take a look at it. So the first thing you have to do building a chart like this, that's just to mute supermicrocomputer, because it's just off the chart and then everything becomes flat if you do that. The semi-micro, their stock price was sort of fixed because they raised money in December, and once those money were in, it was like investors were like, I don't want to pay anything more than anybody just bought stocks in a placement. So, but once that was over, SMI took off, and it's been amazing. And we were looking at it today, doing a DCF analysis and trying to put in some different scenarios, working in what NVIDIA talked about on the GTC, what the SMCI management has been saying themselves, looking at liquid cooling, how um, how small a part of the market is right now, and how big a part of the logic high-end market it's going to be. There is a big runway for that, and Supermicro is partnering with NVIDIA because they're building the motherboards, and motherboards come from being a commodity. It was quite easy to make, but data centers are becoming so complex now that data center builders are using the electronic design automation companies, Synopsys and Cadence, for designing the data centers. There's so many components, so many chips, so many interconnects that you cannot have an architect drawing it or something. You need to design it digitally and automate it. Otherwise, it's too complex and accomplishments. So it's not a commodity anymore. It's a highly complex construction. So yeah, so we're gonna keep riding SMCI. We think there's a long runway there, but it's cyclical, like Nvidia is. Someday there is enough of these high-end data center, accelerated compute data centers in the world, and we're going to have a cooler. So that's what you constantly need to think about as well. Then over to let's look at the other stocks that are in the chart. So the the ice blue one here is Nvidia, which really impressed on the GCC day just last week. Impressed a lot with their vertically integration into the software layer, the software stack. We've known about CUDA, but they're building libraries, they're building small programs, interfaces. They're building solutions for everybody, and we see Amazon just throwing in the towel and starting to accept that they need to use NVIDIA equipment to be competitive on a total cost of ownership basis. So NVIDIA is in great shape, in our opinion. ARM, so hard short term, but long term, it's in amazing shape as well. They're clearing up the 25, 30-year-old x86 dominance, and that's big. And they're also vertically integrating, doing more of the doing more of the designs that chip makers have to make on a day-to-day basis over at Synopsys. So yeah, they're doing good, and they've also been rewarded by the stock market. The next green one here is Vertiv Holdings, which is a specialist in data center construction, and they've bought a company doing liquid cooling to be able to ramp liquid cooling faster, and they will plug that in second half. We think it's run enough right now. At least if it goes up from here, it's because investors are forecasting that their liquid cooling installment and ramp will be a success, and we think that's a little bit too early. It's not necessary, but we're invested and keep our position here. But we'll eventually sell if the ramp in stock price continues. And then we have the red ones here, the fabulous five, the chip equipment makers. The high flyer is Tokyo Electron. They are still selling a lot to Japan. They're selling more of the base materials that are used to make the things that make the lines on the chips and on the wafers, and where the different chemicals are interacting and sedimenting. And and the other AMAT, Lam Research, ASML, and KLAC are are looking weak here, but they're still up 15 or more percent. So they're really, really strong on a quarterly basis. And they're not growing more than they're growing their bottom lines something like 15 to 20%. So market is just pricing in a longer and longer duration of that growth. So it's amazing businesses, but it's getting a little bit expensive, and we're looking out for that as well. The black ones are the fabless chip makers, and we have the two low ones here are Qualcomm and Broadcom. We really are bullish on them. And then we have AMD here, which I lined up with FAT. And AMD really had a rush when they launched their new chip in December, and it seemed like a success. And then then it started cooling off here. I think actually it was on earnings or something, but it started cooling off, and then Nvidia the GTC came, and Nvidia GTC launched a new chip called Blackwell, and it's actually just two of the old chips just merged together. And the bad thing for AMD is that the price is materially the same. So Nvidia just tanked prices for compute. And another thing that's a little bit bad is that AMD's technological advantage has been the chiplet structure, where they merge chip, they build smaller chips, and then they merge them together with interconnects, and now NVIDIA is doing that. And yeah, yeah, and AMD's software layer sucks compared to NVIDIA. So it's yeah, we're skeptical, or we're very cautious, I would say, about AMD right now because the bull thesis sort of waned away a bit here. But yeah, it's tech. We can change our minds in a month. It's so hard to predict. And then the yellow lines here are the EDA companies, the Cadence, the Synopsys, which are designing chips, designing data centers, Cadence designing molecules, Synopsys testing software systems for cybersecurity. Really amazing simulation companies. So exciting, just phenomenally exciting to learn about, and some of the top tech companies, but also very expensive, and that's why they are not appreciating that much in price. So our best performers outside semi industry is I try to list them here, and the one going bonanza here is Root, which is an AI insurance company, actually collaborating with Carvana. Carvana has a stake in it, and they're coming back from the dead, and that's kind of been the story. And that company after company, they come back from the dead. They got the death stamp in 21, price just tanked, and then suddenly it appears that now they're profitable, and now it seems reasonable, and then the price is just way too low. And that's kind of been the story for many of these stocks here during this quarter. Yeah, we looked at Carvana today, and yeah, the DCF is really good at looking at what is priced in, and to get a fair value of Carvana today, you need to keep the growth at 5% the coming years, and it's a company that has only been growing 100%, and they have They have 1% market share. They have the best platform. They have the best business. They have the best consumer scores. They have 3 times the physical capacity they need um, right now. So growth will be good for their bottom margins because they already paid the fixed cost for a lot of the growth. They naturally need to hire more inspectors, etc. But but pricing them, but factoring in 5% of a company that really benefits from growth now and has been growing 100%, that's really interesting. So I think Havana is looking really good. We saw Catalytics coming back from the dead suddenly, showing the growth that they needed to get out of the bad spot they're in. And once they show they're out of the bad spot, there's really long way up. So really interesting. Up a lot yesterday, and then smashing down today because I only looked briefly at it, but it seems like they are IPO. They are releasing new stocks and doing it in a way where they can do it when they want to do it, and that's exactly what Kamana did. It's just a threat to every short seller because if you can't keep the share price down, then they'll start raising cash to pay back the loans. But look, it could be a little more dilutive than what the market thinks. But I think the market should think otherwise. The market should think this thing is priced to die. So them creating another straw that they can use to get out of where they are should actually be a great thing for the stock, even though it might be a little dilutive. Um, yeah, I think I talk about many of these along the way, so I'll just move on from here. Um, here I muted root so that the others don't get so flat. And I just wanted to show you the systemic weakness that we had in January. And that's simply just the sentiment of the market being bad for this type of stocks. And then we got into the earnings seasons, and suddenly they started to pop all of these stocks, Hims and Hers as well. Sea Limited, yeah, Oscar, also just forgotten by the market. A health insurance stock that got a new CEO, really an interesting. And here you see the reason why they are rising so much right now is because they got murdered in 21 and 22. And now we're at the spot where we should consider maybe some of these stocks are actually the winners of the future, and they didn't go bankrupt. So they're recovering. And, yeah, will be the fund to look for, to be exposed to all of these stocks being at and going back to where they want to be. Another thing we're looking for is European tech. It seems like an opportunity. It feels like a systemic weakness. No matter what these companies have done, they've just been selling off due to pessimism in Europe. And yeah, and maybe not so known by American investors. So what you get here is quite excellent. I think HelloFresh Group, the fall just a couple of weeks ago, an immense opportunity to buy a stock that's really undervalued right now. So looking ahead, um, short term, macro is always uncertain. It's always uncertain what happens, what the stock market will think about it. So we can't do anything about that. We need to always think that the market is either going down or up the next month. and then position accordingly to that to be able to benefit from both of that. Long term, we're just going up. AI is the next tech wave. And yeah, I'll get a little bit back to that, but it's going to change the way we live. So that's good. And the impact of AI on society and economics will be enormous. So tech is the place to be at this moment in time for the long-term investor. Yeah. So yeah, I just resumed it. Why it's an opportunity in tech and growth. And tech and growth always get hammered during times of uncertainty because risk market turns to risk off mode. But sometime in the future, stock markets will once again be in risk on mode. So all our stocks will be overvalued in a bubble, or maybe that's just the perception the stock market will have next time it's gone to risk off and has sold off all tech and growth stocks. I'm really looking at the Nifty 50 really made me aware of the opportunity that just because we're used to invest in value stocks, so a P of 25 is high. That doesn't mean that Nvidia or ARM is expensive because they have a P of 40, because they're just going to grow so much and create so much value in the future that it would be ridiculous to assign them with a P of 20 to 25. So if they trade at a P of 50 and stock market suddenly goes risk off and send them down to a P of 25, it was not a bubble. It was stock market being irrational when it was selling off. So there is something there that needs to be rethought, I think. So until now, everything tech was just bombed in 21, 22, and only semi and elite tech has recovered as of now. And I think the real gems, as I alluded to before, is in the younger companies. It's always been like that. It's the younger companies that has the newest tech, has the newest business models, and they're going to prevail because of that. And they're just hammered right now. So big opportunity. Yeah. Is there an AI hype? Yeah. No, there isn't. Excel sheets, that was just smart. Just like the calculator, just smart, helping people doing stuff quicker. But automation, like we see it in Bill.com, and many other companies, Toast, etc., many SaaS companies, that scales infinite, and only at the cost of compute. So no, AI is going to change SaaS companies. So Uber and GPS made logistics workers more effective, but it's nothing compared to when we have robots just automatically doing stuff only at the cost of compute, and you don't have to carry a person around as well. So yeah, there is no AI hype. We might see a drawdown because market lose faith, but AI is real, and it's going to change society and economics. And I'm sorry, Christian, but if you want to hear something about technological revolutions, then this model is relevant. It's by Carlota Perez. She's one of this. Yeah, that's so funny nerding in and learning from. So her model about technological revolutions, I think, is relevant here. So what she says is that you have a long period where you get evolution of new technologies. That was the 70s. And then it starts to get to something, but it's still small companies that apply it, and it's not really something useful, and It's not so much. It doesn't make an impact. If you're a big company, it's only some small competitors that does it, so you don't need to do it. It doesn't matter. And that's the installation period here. And the installation period has been from 1970 until now, actually. To compare it, the last technological revolution we had started in 1915-ish with the invention of the cars. It's about cars, oil, and mass production. And the installation period was in the 10s, 20s, 30s, and then the growth really ramped during World War II and built up to World War II because we needed mass production and we needed to transport labor. We needed the women to be able to go to work so that they could build bombs, tanks, stuff like that for the men going to war. So we needed somebody to take care of the elder and take care of the children. So society changed to a society where you could do mass production. And that's the acceleration period. And then you have the period where all the companies that didn't do it, they can't survive anymore. We're at this turning point now with the IT revolution. PC was smart, internet was good, Excel sheets nice, stuff like that. GPS really good. But now the automation, the robotics is coming, and it's going to change the way we live, and it's going to accelerate everything. So we're here right now, and that's why it's not hype. It just feels fast, but you need to be invested in this right now. So, and then we're going to see drawdowns. Uh, because these companies need to have high valuations. And when market lose faith or trust in the opportunities, high valuation results in drawdowns. And we have the portfolios to accommodate that in the correct mathematical manner. Again, yeah. So that's that's what we produce. So the AI investment opportunity. We have three buckets we think in when thinking about AI. We have the AI infrastructure, the use cases, and the data. And the AI infrastructure, that's what everybody gets right now. That's where a lot is becoming priced in at the moment, and the risk starts to emerge, in our opinion. And when we look at AI infrastructure, we look at both hardware, software, everything that's in the stack for enabling AI use cases to use data to create user experiences in society. And that's one of our theses about this segment. That's the vertical integration. We see that in the dominant companies that are really, really taking off right now. We have NVIDIA. They're producing the chips. They're also producing the InfiniBand, and the interconnects. And they have the CUDA software layer. You can compare that to x86 35 years ago. And then you have now they're building libraries on top of it. They're building solutions, the DDX cloud. They're building prepared models that can do stuff for you. So they are the infrastructure, and they cooperate with Snowflake, Databricks, Confluent. So that's the infrastructure layer. Another company vertically integrating is Broadcom. They bought VMware. They're producing the connectivity chips, and a lot of compute is going to be going on in the connectivity layer, and then they are building software on top of what they got. So they got the vertically integrated stack of connectivity in society. We have Fortinet, cybersecurity. which is one of the leaders in SASE. They have the network. It's network security, so they have the network solution, which is SD-WAN. It's they build a customized chip for that, reducing total cost of ownership, and then they build on the security solutions to that, and that just reduces cost of ownership. So that's the way to look at AI infrastructure. Look for the vertically integrating companies, because that's where and that's Greg Christiansen. He was on the slide that you need to go see some YouTube videos, but he talks about this, that when a technology is not good enough, and AI infrastructure it's in infancy, it's not good enough, it's not fast enough. We can't get real-time AI. That's what we need. And it's too expensive. So it's not good enough. And when something is not good enough, you need vertically integration, because you need to be able to build software solutions that fits the hardware solutions, and vice versa. When it's good enough, you can modelize it, and then you can mass produce it. But right now we need to go back to vertically integration. Then we have the use cases, which is really an overlooked opportunity, and it's all about automation and robotics. And I think the point is that we're not there yet, but we're going to get there in a couple of years, where it's really going to be fast. And remember, the ramp phase in the model is 10 years, 15 years. But we're getting there, and it's going to be priced in by the market before we get there, because it's going to be insanely big. And but there are a lot of use cases today already. Yeah, hims and hers, Chewy, some of them that I really like. And then we have data, which is also a highly overlooked opportunity. And I think that a lot of people are messing around what data really is. So I just wanted to give sort of a top of the mind list of different types of data that you can have. So you can have common data, which is Meta, Google. They know your name, they know where you live, they know who your spouses are, they know what you like to eat, they know what you search for, they know who your friends are, they know what movies you watch. That's common data. That's really good. Then you have knowledge as a service. You have we like to go to the internet and ask about what is this, what is that, and stuff like that. We also like to ask what is the best hotel in Montreal. So there are some big topics, and there are some highly specific topics, and there are platforms or location silos of that data out there that is not just something that you can read the internet maybe and know something about it, but there are concentrated silos of data that will be worth a lot, because we will need to know. We want to have the right answer to the questions that we ask. The sort of the big, broad, multi-topic data silos there is Reddit, YouTube, and X are good examples of that. But hotels.com would be an example of that. Hims and hers would be an example. In a couple of years, they will know which pill is good for a 45-year-old man from Arkansas that is non-smoker. And and hims and hers as well for pets, for instance. Then we have what I call proprietary data, which is best explained by explaining about the company ironSource. It's data that you own and generate as a company by being the company that you are. ironSource is a company that helps lawyers write documents. So they're a SaaS company that has a lot of GDPR and security and can protect your items and stuff and file it correctly, and so that everything is in order. That's the basics. Now they have a writing program, and they add a large language model to that writing program. And the lawyer might ask the large language model, could you make this clause mutual instead of one way? And the Copilot will just go through the clause and suggest some changes. And that you can have any large language model do that, have it trained on some law stuff, and then it'll do it. But what Iron Source is also doing is they're collecting data on, now we made this clause this way. And the case just kept dragging out. We didn't get a finalization. It just kept dragging out, and they didn't agree on anything. So they get the data that when you make this clause this way, the case take a lot of time. So if you're a good attorney, you'll not use that clause. If you're a bad attorney, you'll use that clause to earn more money. But that data is worth something, and it's not available on the internet. It's something that you get from doing the job you do. And every Copilot will be generating data on what works for people, what works in documents, and what solutions work. Creative platforms as well. Grab will know which way the pizza is delivered fast, where the drivers need to be on a specific time, specific day. Instacart will know exactly when a 45-year-old woman from Arkansas puts ketchup in her basket. What will she most likely, what will the ad that will, what is the ad that will most likely succeed in more sell? They will know that from experience working with. And that's proprietary data. And then another thing is real-time data. So knowing the situation of people right now, where are they? What are they doing? What's their intention? What are they trying to achieve? That is real-time data. And only platforms that has contact with people right in that moment. Not just because people are looking on the internet, but knowing what the people are doing. They have real-time data. That's really important because you don't buy pizza when you're jogging, and stuff like that. And we have Instacart that knows where people are, what they're buying, what they usually buy. We have Uber that knows where people are heading, what they're ordering. We have Roku that knows what people are watching on the television, and that matters a lot. So lots of data to look for, and I think that's overlooked right now. And I think there are some really good opportunities long term there. Okay, looking ahead to Q2. Sorry, running a little late. Long term, we believe repricing of the not yet hype tech will continue and remains a 10-year opportunity at the moment. So we remain full gas on reversion to the mean. We believe AI will change the way we live and create big returns for some companies. So we remain full gas on AI, robotics, and automations. Going shorter term for the next quarter, the market seems to be in general risk-off mode right now, and that makes us cautious. And we constantly look for ways to mitigate that and prepare for a drawdown without missing the upside. Semi surge seems warranted, so we stay invested, but we also look for not yet repriced alternatives. SaaS seems stretched, and we remain cautious, waiting for opportunities. Just looked the entire portfolio through over the last couple of days, and SaaS is the hardest segment right now to find good picks in where you think this makes sense long term. Then Europe could be a peak pessimism. Yeah, and then you always need to look for when markets sort of figure out something. Now Reddit just surged on the IPO, and I haven't really looked at it because we've been looking at the portfolio. But they have the knowledge as a service opportunity. Just landed a contract with Google, paying for their to be able to train on their content. Yeah, and just here is from our work in progress. We're looking at Grab here. You can see the DCF model here, and we have three levers we can play with. We can play with the long-term free cash flow margin, with the long-term stock-based compensation, and then with the revenue growth. And when we look at growth, we use the company's guidance for the next year, and then we use the analyst guidance for the year after. Analysts are extremely good at forecasting short-term growth. So we go for that, and then we try to play with the next couple of years, and to assume some things to see what's priced in. And here, Grab is not giving an expected return of 41% in a reasonable DCF model scenario. So here we've been playing around with some of the parameters. So don't look at this number here. Yeah. So that was all I had. And just back to the overview of NewDeal Invest here. With the strategy and the three distribution channels. So let's have some questions.
Yes, thank you, Mads. It was very interesting as usual and very different from what I just heard in the Millionaire Club, where they were talking about AI. This was a bit more structured. We have two questions. Are you there?
Yeah, I'm there.
Eli Lilly has partnered with Amazon to deliver Mounjaro in the US via Amazon Online Pharmacy. Novo is likely to follow suit. Do you see a threat to Hims and Hers future growth?
Now, Hims and Hers are, yeah, they're naturally going to benefit from obesity treatment. What they have right now is just health advice and a lot of that, and so they're not depending on the drugs for that. I think what they're providing is more that you get a doctor, and you get the ability to get a doctor. You have somebody to talk to. It's so important when you have chronic diseases that you have somebody to support you, to talk to, and help you stay in line with your goals and targets, and advise you in different situations. So and Hims and Hers are really excelling on that. So no, I don't think it will. I don't think it changes Hims and Hers where they are in 5 years in any way. Competition is going to be there. The market is enormous, and Amazon is going to be there. Walmart is probably going to sell drugs as well, and I don't know if they do. And yeah, but Hims and Hers has got it, and when you look at them on a DCF model as well, they're just insanely cheap compared to what they seem to be achieving. So yeah, it's just a high conviction stock for us.
Yeah, I have three more questions. One of them is about you did go into this Cardlytics, but how do you see the future for Cardlytics?
They have some loans running out 25, 26, a couple of years ahead, and they're not going to be able to pay them. But if they can show growth, then there's no way that they are not going to be able to refinance one way or another. And I think if you compare to Carvana, then when Carvana was at the low, everybody was saying there was no way, or it could only be this way, or the dilution would be this big. And Carvana just quietly worked their way out. The march continues. And now you see Carvana having the upper hand just because they executed well on their business, and they can actually solve this in many ways now, and can choose. I think the case will be the same for Catalytics if they can grow. And what made us really bump up the position was that they made a new API for a new user experience, and they lost Starbucks as a customer a year ago. And I'm sorry, my voice is yeah, I just it's my vocal cords. But and then they got Starbucks back here in February. It was rumored, and that was just a sign that they got their user experience correct again, and now we see that turning into growth. They onboarded a new big bank. They said at the last earnings report, and are guiding for growth, and and it feels like they're going to be unstoppable if they grow. Then you can't. But then again, if something better shows up, um, yeah, I mean, retail. I didn't talk about that on when I talked about e-commerce. I was planning to mention it that e-commerce is the entire e-commerce segment. They are going to improve their margins because of advertising. Retail media advertising is really becoming great. They know where the customers are. They know what the customers buy. They have all the relevant data. So so retail media will compete with the Catalytics solution. So so nothing is certain, but short term, I feel that momentum will be with Catalytics. But yeah, we were selling yesterday because the position was becoming too big for a small company like that. And now we naturally bought back today when it just fell back to where it was. But we'll be selling again on the way up, just not to have too big a position. But I feel it could go way higher.
Okay, please make short answers so you can save your voice
Yeah.
because there are four more questions and maybe in like four sentences for each. So, how do you see quantum computing in the future for an investment? This must be interesting according to AI.
Yeah, it is, and you need to see it as a competitor to the entire stack as it is today. With quantum, you need new fabs, you need new software, you need new everything. I was at a convention here in Denmark where the Danish authorities and the chip industry and the science was as well. And in Denmark, um, we have over in Copenhagen, we have a cluster working on quantum compute. They're funded by Novo Nordisk as one of the funders, and they feel that they could be building the fab of quantum computing, one of the leading fabs. I highly doubt it. It's going to be so capital intensive. But what I wanted to allude to is that the prototypes are a proof of concept are going to be built over the coming years, and then you really need to start constructing the construction facilities for um, for for mass production in a way that's profitable or that's economically viable. And then you also need to start thinking about the software layer, etc. So we're very early days, and I think it's too early really to start picking for the winners, because most of them are not listed yet, and yeah, it's too far out. I think we have a big opportunity now in AI, and we're just going to double down on that.
Okay, thank you. Sentinel-1, still good long term. Dropped recently. Why?
Yeah, their growth was their growth forecast was a little bit lower. And they had also been chased up from they've more than doubled in I think since last Q2 where they disappointed. So so valuation just got a bit ahead of it. We think it's attractive here, uh, but at around 22 and but not as fundamentally attractive as hims and hers and Carvana, for instance, Oscar. But but when you look at what they're building, then they're building one of the platforms. They're one of the platform builders for cybersecurity, and they could become one of the leaders in that. They're starting from a smaller base than CrowdStrike, which is one of the others, and Palo Alto Networks, which is also on one of the others. But they have they are at the place where you monitor all activity going in and out of a company, and you dump that in a data lake. And they have the most modern data lake themselves, so they have CrowdStrike as customers for their data lake. So they have the most modern design of their competitors. So at least for retaining data. So yeah, we like it and we just want to be long it. And it's not expensive anymore as it was before the drawdown.
Thank you. Jens asks if you will share the slides with the audience or
Yeah, yeah, we'll do that.
yeah, okay. And the last question, how do you look at Marley Spoon at these levels?
Yeah, we had quite a success with Marley Spoon. There was an extraordinary situation where um, Marley Spoon was going to be listed in Europe instead of Australia. It's long been a wish from Fabian Siegel, their CEO, and and we discovered that some of the Australian big shareholders, they could not hold German stocks, so they had to sell the Australian stocks, get out of their positions before they were converted into German stocks. So that put a downward pressure on the Australian stocks because they were forced sellers. So yeah, so we've been buying as much as we dared, given that it's a very small company, and we would be committed to it once we got the German shares in return. There was a fixed swapping relation between the Australian and the German shares, and the German shares they were from a SPAC, so they actually represented cash in euros. So once the stock price of the Australian shares just plummeted, you just got a cheaper way to buy into the Australian share or the German shares. So yeah, we've been buying. So and yeah, and it just doubled our position just a week or two ago. Um, and it's been one of the reasons that the funds has been performing bad because the company actually said that the swap would be in I think it was October, and the swap just came here in February, and the stock price has just been plummeting. So I've been looking at a position in Marley Spoon that was just being reduced to nothing, but I knew that it represented a value in German shares that represented euros. So that's been annoying. But yeah, but now back to the company. So Marley Spoon, they bought they bought a ready to heat factory in Australia, and they lended the money, and then the corona is stopped, and they stopped growing, So they had too much debt for their financial position. Um, and they solved that with some dilution, which was not good. And yeah, I talked to Fabian, and just a couple of months or 1 month before they announced the swap there, and I asked him about it, and he was like, yeah, no, yeah, it's a problem, but yeah, we're working on it. And it was a really good solution. They were undervalued because they like money, and they were merged with a SPAC that had the money. And then on top of that, we've seen HelloFresh just go down the drain as well because growth is falling. So actually now when you look at multiples, as far as I recall, HelloFresh is actually cheaper than Marley Spoon, and that's probably not fair because HelloFresh has got a big a logistics system, and it just has the scale that is a clear advantage. So we came into Marley Spoon thinking it was a bargain and a steal, and now HelloFresh has just plummeted even further. So I think I would definitely go for HelloFresh as it is right now, but I think both will be a really good buy in the future as direct to consumer companies.
Okay, thank you, Mads. There
That
are
was
no
short. Yeah.
further questions, and that's probably good for you to give your voice a rest. Um, the recording will be sent out on mails and so on. Thank you very much. It was very enlightening.
Thanks all. Thanks for listening. And yeah, let's hope for some AI tailwinds.